Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
I will admit it, when I first heard about BNPL, buy now, pay later, I snorted that layaway had died years ago. I was wrong. BNPL has become a huge marketplace. Federal Reserve data pegs it at around $160 billion in consumer credit products. And the scary bit for credit unions is that fintechs own over 90% of that market, and they ain't sharing with FIs. Nope. Enter Equipifi, which has as its mission empowering credit unions and community banks to offer BNPL to their members and customers. Equipifi founder Bryce Deeney was on the show 5 years ago, and again on the show 3 years ago to discuss the market. That market keeps growing. More credit unions are recognizing that BNPL just may appeal to a cohort of their membership, and it may also attract new members. Flash forward on the show now is Lois Smith, past podcast guest when she worked at a different company. Now she is VP Head of Revenue at Equipifi, and she is here to update us on the state of BNPL today. And it's good. It's looking good. Listen up. So let's talk about BNPL. It's a roughly $500 billion market in the U.S., which is not chump change. Fintechs have 95% of the market. 95%. That's in America, that's things like PayPal, Affirm, etc.
Yep.
So what is Equipifi doing in this market?
Oh, gosh. What a loaded question. Well, if you're asking us what it's doing from the financial institution's perspective, we're giving them an opportunity to compete because, to your point, the lion's share of the market is owned by fintechs, Affirm, Klarna, Afterpay, Sezzle, Zip, Tidbit, Sunbit, Fly Now, Pay Later. I mean, it feels like a new one's popping up every day. And financial institutions have largely not participated in that market. And so then when you flip to the consumer lens, what we're doing for consumers is giving them a safer alternative to the existing solutions that are out there today. And what I mean by safer is, a financial institution has a lot more data on their members or customers. And so they can have a little bit more visibility into what type of lending or what limits of lending are going to be healthy for that particular consumer as opposed to overextending them, which is a pretty large concern with buy now, pay later. So ultimately, TLDR, I'd say, we're providing safety, and we're also providing financial institutions with a chance to compete and continue to keep that relationship.
Do any of the credit bureaus track BNPL? I know they've been talking about it a few years ago. I don't know if they actually acted on that.
They do talk about it, and FICO did release, I think it was last year, saying that they were going to begin incorporating BNPL repayment behavior and trade lines into their FICO score. The reality is the way scores are calculated today has a lot to do with the number of trade lines and the length of those trade lines. And so when you think about buy now, pay later as being a short-term small dollar loan, or at least that's what it looks like to a bureau, making all of those payments on time and in full, just because of the short trade line, it's actually a negative impact to score based on those traditional markers. And so I think they're all still kind of trying to figure out how to incorporate it without harming a consumer for displaying good behavior.
If talking with you, it occurred to me, I should have researched this before, but you're here, so do any of the big banks like Chase have their own BNPL solution? In other words, are they offering that?
Yes. So we can certainly start with Chase. So Chase has both a credit card product and a debit card product. They call their credit product Pay Over Time, and then their debit card product is called Pay in 4. So the way that their credit product works is if you use one of their credit cards, let's say you've got a Sapphire preferred card, and you make a purchase that's of a certain size, they offer you the ability to remove it from that revolving line of credit into an installment plan at a lower interest rate. The objective for them there is to drive more engagement, their credit card portfolio, and offering, the ability for those consumers to save a little bit of money. It is a cost center product for Chase, but it does drive engagement. The debit card product is, I believe the purchase needs to be at least $400. At least that's what it says when I take a look at it. I have a Chase debit card. And then you have the ability to pay it off in 4 payments for a fee. So they have it today.
Now, my sense of big banks is that Chase doesn't give a hoot about defaulting $500 debt. It's totally irrelevant. Credit unions sweat about that, and I've never quite understood it. It's $500, man. But they do sweat about it, and it's no matter how much I make fun of it, they continue to sweat about it. So I'm not going to change the behavior.
I mean, delinquency is on the rise right now. As consumers are, inflation increases, consumers are strapped for cash more and more. These smaller financial institutions are seeing their delinquency rates rise with their traditional credit products, like a credit card, as an example. And so I think it's just the concept of introducing more risk into their portfolio. But to your point, it's such a tiny percentage of the overall portfolio with such a huge benefit to both the consumer and the financial institution in the form of loyalty and engagement. And I think that gets lost sometimes. You're kind of throwing the baby out with the bathwater on that.
Google Gemini tells me there's 2 kinds of BNPL. There's what it referred to, if I remember correctly, 4 payments and it's done, which is usually small dollar amounts. And then there's a longer term BNPL relationship. Does Equipifi power both of those options?
So we allow our financial institutions to structure their own plans. And what I mean by that is they have the ability to control both the interest rate and the term length that they want to present to their members and customers. So you're right. There are multiple flavors of it in terms of what the plans look like. I will say that we funded our home gym with a Pay in 4 BNPL product at 0%, which was great. There was no reason not to do it. So it is for larger purchases as well. But that's really just the reason the Pay in 4 kind of exists is that was the established market structure that a firm put out there. So then others kind of followed suit. But our clients ranged in anywhere offering plans from 3 months all the way up to 18 months. So naturally, the larger the principal or the larger the loan amount, the longer term lengths make sense from a budgetary standpoint for the consumer. So it's really just up to the FI what they want to put out there.
So, and the Pay in 4 typically doesn't have an interest charge, and the longer term one does. True?
No, not necessarily. So going back to Chase, their Pay in 4 product does have a fee attached. It's just the Pay in 4 is just referencing that it's 4 payments. And typically those are biweekly, so not monthly. So every 2 weeks, there's a payment involved. So yeah, not necessarily, although I will say that the large fintechs like Affirm and Klarna, as an introductory or a promotional offer to get more consumers into their ecosystem, they'll offer their first plan at 0% interest, which is, again, going back to the gym. That's why.
Man, this is like an old street corner drug dealer. Come on.
I can't agree with that, but
you've never had a heroin shot. You're going to love it. It's free for you today. It is free. I like you a lot. Now, here's a gift for you.
I guess you could make that parallel. They have to get the way that these companies grow is based on the number of consumers they have in their ecosystem. So I'll give you an example. Affirm, they have over 20 million consumers in the US that have used buy now, pay later plan through Affirm. That is their starting point, like their land. And now they are expanding in the form of traditional banking accounts, like a checking account. They are shipping out debit cards at a record pace to all of those consumers so that not only are they able to offer them more buy now, pay later opportunities, but now they're trying to gain interchange. and gain that everyday banking relationship with them. And it's why they applied for a banking charter as well. So yes, to your point, they've got to find something interesting or a nice incentive to bring them into the ecosystem, but it's really what happens after that that is paving the way for their future growth.
Now, Gemini this morning did tell me that 90% of the US BNPL market is dominated by fintechs, but Equipifi plays in this much smaller but potentially big market of B2B. So you're dealing not with the consumer. You don't want anybody to know the name Equipifi,
Mm-hmm.
but so you're powering this in banks and credit unions. Are there competitors in that market?
No.
That's
No.
kind of what I was gathering, that you're now, are you sure you're smart being in this market since no one else wants to be in it?
I say no, but I'll give you an example. A firm recently did a partnership with FIS and Fiserv. So for, FIs that work with Fiserv cores or FIS, and from a processing standpoint, they have the ability to work with a firm to bring buy now, pay later to their customers and members. The only difference there is that a firm owns the relationship.
I
And
see.
all of those loans sit on a firm's books. So the reality is a lot of financial institutions don't love that because it does appear to be, you're basically letting the fox into the hen house because you know that a firm has already said the quiet part out loud that they want to be a bank. And by giving them access to your customer base or your member base, if you're a credit union, and letting them keep those loan products on their books, you're just giving them business. Now you may be getting compensated in the form of a referral fee or whatever, terms they negotiate there. But that long-term relationship is officially at risk when you're giving them direct access to your customers.
Yeah,
So,
that makes sense. Some years ago, I was talking with a lot of hoteliers, and they really hated Expedia, which made no sense to me. But the reason they really hated it wasn't the fee they were paying; it's that Expedia owned the customer. The only
Mhm.
thing they knew about the guest was the guest's name. That was about it. And Expedia was not really willing to share any other details.
Yeah. Yeah, that makes a ton of sense. And really the relationship with the end consumer is what is going to make a financial institution relevant or irrelevant in the next 5 years to 10 years. And you have all of these large fintechs that are vying for that business. I mean, you just look at Chime, SoFi. I mean, they came in so quickly and have scaled, past the likes of big banks that we are typically used to in market, leaving small to mid-sized financial institutions playing catch up on digital experience, customer experience, products that they want. And, buy now, pay later is just one of those things that they're playing catch up on.
Now, you have roughly 60 credit union customers.
So we have 110 now. We're growing quite rapidly. We just closed our Series B, which is helping us to accelerate a lot faster. But yeah, so we're over 100. We have about almost 80 of those are live clients today.
What's the size range?
Oh, we love working with institutions, as small as a quarter million in assets all the way up to 20 billion.
Did you say a quarter million in assets?
Or quarter billion, sorry.
Oh, I was
Quarter
going to
billion.
say,
Oh
I
yeah,
was
we have
going
people that
to,
support one member.
yeah, we do
They are
like
themselves a credit union.
pocket change bank. Yeah,
Yes.
come on.
Yeah, no, so quarter billion in assets all the way up to 20 billion. Our product is able to support institutions of any size.
What do you need to integrate your product into their core? And I assume this is integrated in the core.
It is. So we require a core and digital integration. So today we support a handful of Fiserv cores, both cores offered by Jack Henry, Correlation, and we have some that are in the works there, but they have to have one of those cores that we are already integrated with, and then the digital. We need to be working with their digital. However, we're adding new digitals all the time. There are very few that we don't work with yet today.
Yeah, I would assume the core integration is the biggest obstacle.
Yes,
Well, there are hundreds of cores out there, including many that were created before you were born.
true. It is true. There
And
are,
those suckers don't really integrate real well. So
well, it's funny you say that. There are some cores that, have been more challenging than others. And we joke that the integration is just data by carrier pigeon.
yeah,
And the integration is setting up pigeon farms on either side to make sure the data gets transferred. But yeah, it's always a challenge. It's a challenge for every fintech, but it's something that I'm super proud of our team. We do so well. We have an excellent engineering team, an excellent product team that's able to kind of go in, suss out what needs to be built.
now is most of this team in Scottsdale
Most of our technical
dispersed?
team is, but we're a remote first company. So there are certainly benefits to having a lot of our engineering and product teams in the greater Phoenix area, but we're all over. I mean, my team personally on the sales side, I have, is it 7 or 8? I think I have 8 people now, and they're all in different states.
But Zell is up the street from Equipify, I think.
Yes. Yes, you're
So,
right. Early warning Zell is, yep, just down the road.
and now when BNPL launched, the general belief was that this would appeal primarily, if not exclusively, to Gen Z and young millennials. Is that still the primary audience for this?
So broadly speaking, if you're including just the entire BNPL market, it does skew more towards younger generations, which look, that's a good thing, right? A lot of financial institutions, that's an area of weakness for them is engaging with.
Well, a lot of kids say credit cards are evil.
Oh,
I don't know why they say that, but they do, and no point in arguing with
a lot
them.
of their parents went bankrupt with credit card debt.
And
So,
they
uh,
also had friends who got
yep,
credit cards. I mean, there was a time when big banks were saturating college campuses with credit cards, and kids would run out and incur $5,000 in debt with no potential to repay it, none whatsoever.
I mean, look, I was one of those kids. I mean, I eventually repaid it, but yeah, it's a real thing. I mean, orientation, you go in the first 2 days, you got those booths, right, where everybody would walk around, and yeah, it was Amex and Visa and all of
Well,
them
you
around.
went to a very good college, and I'm sure those credit issuers thought all these kids come from families with some money, and they're going to make some money so they'll pay off this damn debt.
Yeah,
It's
smart on their part, certainly. But you're right. It does skew towards younger generations, but the data that we have shows that, all demographics use this. Millennials are the top for us, but then Gen X is actually second, and then Gen Z is third. Now, granted, when you think about credit unions or community banks, their average member or average customer age tends to skew older. So, not if you were to look at the same data from SoFi or Chime, you would probably see it skewing a lot younger. But we see, we have there was a 93-year-old woman that used this product.
well,
It's
I would also think very importantly, if I'm a credit union executive, I'd be interested in this because they're all struggling to attract more young members, and this might help me get more young members in the door.
Oh, it's a tale as old as time. I have this conversation with FIs all the time. It's an area of focus, and the tough part is getting them to make the decisions to actually do the work to attract those younger generations because it does take a lot of work. And they are playing catch up against large financial institutions with multiple billion dollars in engineering and product budget, which they don't have. You're not wrong. Marketing is always a challenge, but for smaller institutions, they run very lean teams, right? And so marketing used to be you would get a bureau pull of data on your membership or your customer base, and then you would send quarterly ads in the mail. Like that used to be what marketing was. It wasn't until the late 90s and early 2000s that they actually started investing in websites. Like that wasn't that long ago. So getting them to kind of come around to how do you get in front of a Gen Z audience? It's not you're not sending them physical mail. That's not going to work as well. It does work. I'm not going to, like, I've also sold print mail, print advertising, and it does work, but it's at a decreasing rate. So you got to do a little of everything, but that's not going to be the way that you get Gen Z. So you're right. They do need to do a better job of marketing when they have solutions that they know that Gen Z likes. You got to let them know that they have it.
So how do you sell Equipifi to a credit union?
What I've found is the best way to quantify a need or a value to the credit union is not by telling them that something's valuable. You have to show it with their own data. You have to show them that they have a problem and they have to uncover it on their own. Otherwise, you're just kind of a voice among a crowd of fintechs that are all vying for their attention and telling them that their technology is the next thing that they need for their business. What we've done and what we do with all of our clients, which has been super helpful for them, even if they choose not to move forward or kick the can, is show them how many of their members or customers are actively using third-party fintech BNPL today. And
How do you get that data?
so a couple of different ways we can do it. Easiest way is to go to the core and look at all debit card transactions. Because we know, yeah.
So yeah, if you see me paying American Express, I don't use BNPL, but you say,
Right.
well, his primary relationship actually is with American Express. It's not with us.
Yeah, that's true. That uncovers another problem. But with this, it's if you see a firm coming up frequently, Klarna coming up frequently, and there's a number of other ones you can be looking for in those debit card transactions, you obviously aren't offering them a product that they want or need to use, and they're getting it somewhere else. Now, if you start looking at your ACH transactions and you see a firm coming up, well, that's a much bigger problem because what that means is that member has already replaced that financial institution from a top of wallet standpoint. They're using the Affirm debit card as opposed to the credit union or community bank's debit card. So you're losing not just the loan activity there, but also the interchange and the daily banking interaction with that consumer. So kind of painting that picture for them and showing them that, hey, you should also pull this data next year and see what the growth of that is. And that starts to be a little alarming, and it makes them realize, hey, we need to come up with something like a solution that's somewhat similar so that we can recapture some of that behavior and keep that relationship strong in-house.
What's the biggest financial institution, credit union that uses Equipifi that you can name?
Oh, that we can name. So we work with Michigan State.
Oh yeah, that's a good one. They're big.
Yeah, they're big.
They're pretty progressive. They'll try a lot of things.
Oh yeah. Yeah, they
Yeah.
have an excellent pipeline of new products. And the thing I love about Michigan State is they have a great innovation program and an incredible team over there that runs it. You know, Ben obviously at the helm as CTO, but then you got Philip in there who does an excellent job of identifying innovative fintechs that they should be working with. Yeah, they have a whole built out process for vetting fintechs, you know, piloting them, understanding the impact to their members. They have a subset of their membership that's like raised their hand and agreed to be a test, like guinea pigs for these products, which is really cool. And I think if they were able to kind of give other credit unions the blueprint for that, I think credit unions would make decisions a lot faster and maybe move on more innovative product opportunities rather than the traditional way that they tend to evaluate.
I semi-agree with you, but I also disagree where Michigan State is big enough so that they have the bandwidth to entertain multiple fintech experiments at any one time. Whereas I'm talking with even $1 billion credit unions that claim they're kind of tapped out just dealing with AI, and they're not really that desirous of trying to play with new fintech other than AI.
It's funny you mentioned that. I mean, AI for sure, that's going to consume every financial institution over the next few years. But I mean, I'm still talking to financial institutions that haven't even invested in new account opening yet. You know, like digital account opening. Who would have thought? Like we're in 2026 and there's still FIs that are working on that. So,
I believe you, but that is frightening. That is
yeah.
also a reason why credit unions, or some of them at least, are finding it difficult to compete today. It's
Yeah, it's another reason you're seeing, an increase in mergers and acquisitions. I mean, that's only going to grow over time,
so once Equipifi is in place in an institution, what kind of staff commitment does the institution need? How independently does this run on its own?
So we'll typically have just a product manager or project manager that kind of manages through the implementation, make sure it's turned on and working. But the beauty of the product is it's all automated. So it doesn't require, it replaces that whole, hey, we need a human to look at a loan application before we actually approve it, and we need a human to look over the processing of it before we actually fund it. This eliminates all of that. So you don't need anybody on the lending side looking at every single member and the loans that they're taking out. Everything's automated on the back end, from presenting the offer to the consumer accepting the offer, the funding of the offer, and the maintenance of the loan. That's all done automatically. And then contact center, branch staff, we arm them with some FAQs and a little bit of training so that if members call and have questions, they'll be armed with the right responses. Ultimately, it's business as usual and no additional lift on the team. So, one or two people to just manage the program and make changes to the underwriting criteria if they feel like that's necessary, and have a chance to talk to us on a quarterly basis to monitor growth.
Yeah, that's fairly minimal staff commitment.
It's very
So now, of the applicants for a BNPL loan or whatever you call what's happening there, what percentage is approved typically?
So it's an application-less software. So these are all pre-approved offers. So there's no declined applications, no declined offers.
Now, how is it pre-approved?
So we have a proprietary decision engine that we run on the back end. This is part of the core integration. So we're able to ingest data around that member or customer. And with the financial institutions tweaking of our criteria in the decision engine, they can align with whatever risk profile they're comfortable with. And then we'll run that data through our decision engine, and it'll spit out who's approved and up to what amount. And then those offers are displayed in digital banking to those individuals. And it's fluid and always on. So as things change with their cash position and other relationship criteria with the institution, we'll update those offers or remove them when it makes sense.
So you'll run the 100,000 or however many members Michigan State has, for instance, through the system as soon as you're bringing them live, or as you're bringing them live, so that all those decisions are already made.
That's correct. So before we even bring a client live, we'll run their, like if it's a credit union, we'll run their member data through our decision engine. And before we bring them live to members, we'll say, hey, if you went live today, this is how many members would have offers. This is how many members we anticipate would take out a loan. This is how many we would prospect to be going delinquent. Are you comfortable with this level of activity? And they can say yes or no, make some final tweaks before we actually bring it live to members.
I'm remembering that I've seen offers, unsolicited offers from American Express and also from Amazon saying, hey, you could pay this out in 4 installments over time with no interest charge if you'd like. It's I use a Chase credit card, so maybe Chase is involved in that too. I really don't know.
And you've got folks like Plaid too. So sometimes, like a firm, for example, if they don't have enough data on a particular individual, they'll have them run their info through Plaid to get more connected bank account data to better understand their cash position and repayment behavior. Consumers don't have to put that in, and then that'll obviously limit how much overall BNPL purchasing power they might get through a firm.
And this question is going to be hard, but
okay, try me.
Well, it's a data question. It's not necessarily that you want to wriggle away from it, although you might. I don't know. Like roughly, when you integrate in a credit union, roughly what percentage of credit union members are using this option?
Mm, Anywhere from 8 to 12%.
Whoa, that's not bad at all.
Yeah, anywhere from 8 to 12%. There's a number of things that impact that number too. If you have a credit union that, let's say, has a really lean marketing team. Now, granted, we have an excellent marketing team that empowers our clients by providing collateral. We do email marketing on behalf of our clients, especially those with lean teams. So there are things that we can do to help them with that. But if they're not marketing it themselves and members just don't know that it exists, that's obviously going to have an impact on adoption. The other thing that can impact it is, let's say you have a credit union that is majority affluent, right? Folks that love to get points, rewards credit cards, right? They're going to have a little less usage than your average financial institution that has a good stratification of all income levels within it. So those are a couple of things among several that can impact that adoption level. But yeah, on average, 8 to 12%.
That's pretty good. Now, what if I have a friend who has a bank uses the same credit union I do? And the friend tells me, oh, I was offered this BNPL thing, and I look and I've never seen this sucker. So I call up my credit union and I say, now, why is my friend seeing this and I'm not? So how does that conversation go?
So we'll work with each credit union based on what they told us the criteria were for qualification. We'll help empower them with some, easy answers to those questions. Like, for example, some of our credit unions require a direct deposit relationship for eligibility for buy now, pay later. So it's a great opportunity to have that conversation with the member.
That's
Like,
that's good. That's
yeah,
not a bad criterion.
yeah, that's right. So that's just an example of something that we would kind of guide the branch person to say or the contact center person to say.
Oh, and it would be less, I'd be less offended if I was told, well, it's because you don't have direct deposit and we require that and before we enable this, blah, blah, blah. I'd say, fine, great.
Yeah. Yeah.
So what attracted you to this business, this BNPL business when you switched and left Array, I believe it was, and came to work at Equipifi?
And shout out Array. I love Array. I love my people at Array. We still all get together whenever we can. It took me a while. I wasn't an easy convert. Bryce Deeney, our CEO, he had been pretty much trying to bring me on from the moment he started the company. And I just wasn't sold on it, primarily because I wasn't a user of buy now, pay later. And I think this is often the trap that a lot of credit unions put themselves in, is because they're not a user of it. They assume that the rest of their members aren't using it, right? And I was for sure in that camp. I was like, why wouldn't somebody use a credit card? Of course, not stopping to think, well, just because I have a credit card doesn't mean that everybody qualifies for a credit card or that everybody wants a credit card, to your point, Robert. There's a whole cluster of people out there that just would never get a credit card. They just don't want one. And so it took him a while to convince me of the growth of the market, that it's more of a payment method than it is a loan type, that it's just a growing way that consumers like to manage their money and budget, their month-to-month expenses. And so once he finally started showing me the data of the usage that's growing year over year and how people are using it, and I was finally convinced that, wow, yeah, this is something that's going to be huge. And the fact that financial institutions aren't jumping on board is something that I can help with.
Well, and it is an interesting issue when fintechs control a vast slice of this market, and credit unions and banks will struggle to capture more of that market share.
It's rare that they're going to come in with the lion's share of the market. Fintechs have normally been the ones playing catch up to do things better than financial institutions, but with financial institutions having most of the market share, this is kind of an inverse of that, where fintechs created a product that, consumers love, and financial institutions just ignored it. for a really long time.
I'm guessing, and here I could be totally off base, that initially many of the CEOs of financial institutions were people my age who said, hell, this is just layaway, and I don't want layaway customers. This
No
is
doubt.
crazy. Get this out of here, man. Go away.
Oh, no doubt. I talked to a credit union CEO a couple months ago, and I asked him what he thought about BNPL, and he goes, I don't like it. I don't like it. This is layaway. Except you get to
It-
keep the thing before you pay for it.
oh, that is a big change right there. Number two, it goes back to that generational echo where there are these people, let's say between 20 and 30 or there, and we're just using rough numbers,
Yep.
who seem to really like BNPL. And they actually are making the payments. I know there originally was just absolute fear about what the delinquency rate would be. It's not bad. It's going up, as you said some time ago, but it's still not what I view as a horrendous rate. I mean, they're used car lots that have a 30% delinquency rate and default. And they're in the business of getting that so they can repo the car and sell it again to somebody else.
For sure. That's a whole
That's we don't want to talk about that.
Yeah, but you're absolutely right. I mean, the CFPB actually did a study a couple years ago on buy now, pay later, and whether individuals who used buy now, pay later were more delinquent on their other responsibilities, like their other bills.
That's a good question. I'm glad they asked that.
Yeah, and they didn't find a correlation at all. In fact, they found that I can't remember the exact number, but it was over 90%. Like I want to say it was 93 or 95% of all BNPL loans were eventually paid off in full, which is a huge percentage, especially, and keep in mind, these are small dollar loans, but they're finding that because of the installment nature of it, where it's a predictable expense, also because the vast majority of these are on auto pay, they're not manual payments like a mortgage or an auto loan or something like that. Most consumers elect to have it be on auto pay. That's another way that it's keeping delinquency lower than other loans. But yeah, no, I mean, consumers are a lot more responsible than I think the media portrays them to be. And they're using this tool as a budgeting tool. Here's where I see our product really fitting a need that banks and credit unions can't fill. I'll just give you an example. Let's say you are a middle income person, you get paid twice a month. You know when those paydays are. And usually you're really good. Like you never are late on your bills. You know exactly when your bills are coming in, you're paying them off, everything's good. And then, your dog gets sick. Right? And it's $2,000. You weren't expecting that. And let's say you don't want to put that $2,000 on your credit card because the interest rate is 20%, and you just want a predictable, low-cost way to just spread that money out until your payday. That's where BNPL comes in, because you're not going to walk into a financial institution and go, I need a loan, or your dishwasher breaks. You need to replace it today. The dishwasher's $800. You don't want to go into a credit union and go, can I have an $800 loan, please? Let me apply for it and take all that time and wait until you approve me. Like, you just want to go to Home Depot and buy a dishwasher. So that's where I believe our product fills a gap for these institutions, because, when unexpected things happen and you just need a little cash flow to float you, that's what this does. It helps smooth things out.
And this, I assume, is at a lower interest rate than a payday loan would be.
By a long shot, yeah. I mean, most payday loans are in the hundreds of percents. Our FIs choose what interest rate to market these at, but it's anywhere from 10 to 18% is typical.
And that's very good. Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey again. That's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.